David, what is the character of this inflation in 2025?
Well, it's a real dichotomy, Tom, and a bit of a head scratcher, especially from the numbers that we got in July from the CPI and the PPI, because we're all expecting that the tariff impact is going to hit the goods sector. But was really puzzling in both reports was the fact that service sector inflation isn't going away. And I think that's a bit of a problem for the Fed. I still think that the trend in inflation will be heading lower. I wrote a report talking about something very nebulous, otherwise known as the quantity theory of money, in my daily yesterday, going through money supply growth, which is starting to cool off, and money velocity, which is flattening, and in relation to where the real economy is, and then solving for inflation. And we're going to be getting towards the target or probably below, but not for another 6 to 12 months. So it's a trend, but it's not a present day reality, but it's out there.
As we had stimulus in three, Olivia Blanchard calls it the Biden stimulus, the back stimulus of COVID. I mean, is it just simply, David, as you say, you delay a disinflationary call out 18 months, say, is it because of the stimulus of Mr. Trump's new legislation just passed?
Well, you know what everybody calls stimulus from the big, beautiful bill really isn't stimulus from the status quo. The biggest chunk of that was just maintaining the tax cuts from 2017 in the personal sector. And then you could argue that the bells and whistles, mostly from the depreciation allowance benefit, insofar as that, improves the capital spending picture, that is supply side growth that you would hope would generate productivity, which is then antithetical to an inflation view. So I don't really look at the fiscal side as being a source of inflation. Of course, the greater supply that we're seeing benchmarked against expectations is what's caused the back end of the yield curve to remain so elevated. But the inflation that we're seeing primarily is coming from the tariffs. For anybody that thinks that tariffs will not be at least near-term inflationary, seem to ignore the fact that it's the importer on record in the United States that actually pays the duty. Then the question is how it's going to get distributed through the supply chain.
Right.
But I said the head scratcher, and it's just 1 month's worth of data. But I was really surprised in July to see how stubborn the service sector was, because that's a part of the economy that had been cooling off. But those inflation numbers across most of the services, not just shelter, were a big upside surprise last month. I'm just hoping that it's not going to be sustained.
David, economic growth remainder of this year going into next year, I think most folks are expecting it to continue to soften, but still be some reasonable growth. How do you think about GDP?
Well, everybody has, I guess, redefined what reasonable is, or what Jay Powell describes as solid, when we're barely running the economy so far this year, barely over a 1% annual rate. I mean, when I started in the business in the mid-'80s, you got down to a one handle on real GDP growth, and people weren't talking about reasonable. People were talking about stall speed and then asking, when's the recession going to start? So the economy, I think, is sputtering. It's uneven. Without the proliferation of AI data centers and all the technology spending related to generative AI, the economy would actually be in recession right now. That's been really the only underpinning, the only impetus to growth so far this year. So I'm thinking that the economy is going, I don't see what the catalyst is going to be. Even with the big, beautiful bill, it's not going to be adding a whole lot to growth, a little bit. And I think that the tariff uncertainty is still going to be a big element that's going to provide an overhang on the economy going forward. And the Fed's going to be deliberately slow to cut interest rates. So that's going to have an impact negatively on the credit-sensitive sectors of the economy. And it's not as if the rest of the world is actually operating at a very high level of economic activity. That's going to come back and bite the export sector. So I think the economy is going to remain very weak. through the balance of this year and the next year. The only question is for the Fed is demand weakening in relation to what's happening on the supply side? Because the supply side is also weakening alongside the demand side. From an inflation standpoint, it's how those two curves, demand and supply, in the broad economy, how they're interacting, that's going to determine what the inflation outlook is going to be.
David Rosenberg with us. We continue with Mr. Rosenberg. We welcome all of you across Canada and David's Toronto. Thank you for joining us and the way you listen to us on SiriusXM and other outlets as well. Apple CarPlay, Android Auto. Good morning on YouTube. It's building each and every day. Paul and I just sort of blown away by the whole Google YouTube experience. Subscribe to Bloomberg Podcasts is the quickest way to get us and get us often as well. What he said there about ages ago, Paul, where a 1%, 1.x% economy was stall speed. Why has that talk gone away?
I haven't heard that. Yeah,
to me, it's this divide between the haves and the have-nots.
Yeah, exactly.
But I think David's dead on about how the recession language has changed.
David, given that backdrop of slower growth, percolating inflation, what are we going to hear from Fed Chairman Jay Powell on Friday from Jackson Hole, do you think?
Well, it's a great question. If this was September the 10th, say a week before the FOMC meeting, given that there's 85% market-based odds priced in for a 25 basis point cut, he would probably acquiesce. But there's still a lot of time. And I don't think that Jay Powell in his mind thinks that we really have an 85% chance of seeing a rate cut. So this is really more of a trade. I think over time, the Fed will cut rates at the right time, probably cut them aggressively in the next year, but again, at the right time. I have a tough time believing that he's going to be talking dovishly, at least relative to what's priced in. I would expect to see on Friday morning those 85% market-based odds of a September rate cut. I think they'll be dialed back. And I say that because, everybody seems to believe that because the thesis of the Jackson Hole Symposium is about the labor market, everybody seems to think, well, we had a pukey July non-farm payroll number, downward revisions to the previous 2 months, so it's got to be dovish. But I think what's going to come out of it mostly is a sign that, yes, labor demand is on the decline, but guess what? And this is what I mentioned before, labor supply is also on the decline. And how those two wash out is going to depend on what the Fed's reaction function is going to be. So I think that there's going to be a lot of surprises. I think that he's not going to sound uber hawkish, but I think that benchmarked against what's priced in, I think there will be disappointment. And I think there's actually a good chance, despite all the political pressure, because you got a Fed chairman, he'll be gone after May. He is going to be determined to preserve his legacy. And I think he's going to block out the noise from the White House. So my sense is that, and this is from a bond bull, but I think over the near term, the outlook is clouded. I think that although you have some dissents, and remember that Volcker, back in the mid-'80s, would sometimes face a meeting with at least 3 dissents. So that could happen. But the chairman is usually in control, and I have a tough time believing that he's going to sound as dovish as what the markets have priced in right now.
David, are you surprised that the equity markets have rebounded the way that they have coming off some of those tariff concerns earlier in this year? And if so, what does that tell you?
It tells me that there is a ton of speculation in the marketplace, especially as it relates to the productivity and return on investment assumptions coming from the technology boom. So, we're reliving to some extent, not fully to some extent, what happened in the late 1990s. This usually happens after a major shift in the technology curve. The markets get way ahead of themselves. And I think that that's been a big part of it. Of course, you've also seen the market broaden out. Even in this very weak economic environment, I mean, it's not a recession, but 1% plus growth. But you've seen the market broaden out. I think a lot of that has come most recently from this view that the Fed is going to, ride the cavalry and start cutting interest rates next month. I think that's where the folly might be. Right. But I'm taking a look at this market, and look at where real rates are, roughly 200 basis points, benchmarked against what, like a PE multiple forward of around 23. If this is not a bubble in the equity market, and I know that people view that as a very emotional word, if it's not a bubble, it's a giant sud. Okay, so we're
Right.
just back into psychology of a bubble mentality as it pertains to the broad equity market.